Hello and welcome to the Retirement Planning Show. I am your host, Jenny Jones. On this week's show, we talk about the Federal Reserve, often referred to as the Feds. We talk about your favorite cereal and why it may taste different in your retirement portfolio moving forward. We also talk about inflation and how is it affecting your retirement portfolio. We talk about political risk and how it affects your portfolio. We also talk about some winners, some stock winners, and where to look for them in your retirement portfolio. I would like to share my disclaimer to you as a professional. What I will be sharing to you is all public information and can be found on any public forum. Please seek out your own personal advice for any financial positions in your personal retirement portfolio. Any advice that I may share is from a position of a generic person preparing for retirement and should be considered as such. All right, thank you. So let's go ahead and get started. Now, what happened this week is the biggest event actually happened last week concerning your retirement that is affecting this week. And that's because the Federal Reserve Chairman Powell, and he's over the central bank, and his team decided to raise interest rates. Now, how does that affect you as a retiree? Well, it affects interest rates on loans and overnight lending. If you are planning to refinance your home or things of that nature, then it could have an effect. And definitely if you're moving into your last phase of trying to transition into retirement, whether it's in the next 12 months, next 6 months to 12 months. All right, so let me explain it in another way. The Fed is the person that has their foot on the gas pedal of the economy. If they look at indicators in the financial markets and decide that the interest rates are too low, then they may make a determination to raise the rates in small incremental movements called basis points. Usually the movements are in basis points of a quarter of a point on those types of increments. So they're usually smaller. I do not want this to be too technical for you because this show is not about technicality. It's about just trying to bring basic things down to you so that you would understand and see how it affects your retirement. But I don't want to get caught up into these high level technical terms. Essentially, it's what they'll do is they'll show the incremental points and changes is if they decide that there are too many dollars in the hands of U.S. citizens or the country as a whole, they slowly raise interest rates to slow down lending and borrowing. So they raise the overnight rates so the banks will have to pay more to lend out money. So it tightens the money supply. And this prevents inflation because, let me explain it to you this way. Let me give it to you a practical scenario so that it makes more sense to you. Back in 2005 to 2007, everyone was buying homes as the interest rates were low. And anytime the interest rates are low, it gives people access to capital or in other words, cash. When there's too much money in circulation, then the prices for goods and services have a tendency to go up, a la homing prices. From the demand and with the people who have the ability to pay those prices. That's why the prices continue to go up because people have the money to pay it. Well, they have the money or have access to the money to pay it. This actually prices a lot of everyday people out of the market and prevent them from making everyday purchases. This is called inflation. When the prices of goods exceed the average price, and that's what the federal chairman is trying to do. He's trying to pull that back. And if he pulls it back, he tightens the money supply, then it has a reverse effect and it makes prices actually end up dropping and going down in the other way. Whew. Okay, I got that out of the way. Okay, the activity this week, let's talk about that. It's actually because of what actually happened last week. The Feds raised the rates 0.75 basis points, right? So that's signaling that inflation or the cost of goods are too high and they must get a handle on it. This week, you saw a lot of movement in the stock market, which essentially sits behind directly or indirectly of everyone's retirement plan, but mostly indirectly. But it still has an effect on your retirement plans. Last was statistically the worst week of the year, right? So last week was just terrible. And most of that was in anticipation of what the Fed was going to do with the rates. The overall market was down 11% over the last 2 weeks. So it has been a tough end of the quarter, to say the least. You see, in the markets, there is usually always a cause and effect for any news, whether it's good or bad. As a person preparing for retirement, most daily market fluctuations should not be your immediate concern. You should leave that to the day traders or large institutions. Let's talk about political risk for a minute here. This is when political elections or re-elections affect the stock markets. As a retiree, I should shed some light on some decisions that may affect the market only. I will not get into picking sides, name calling, or mudslinging or anything like that. That's not what this show is about. My concern is for you as a retiree on your way to your retirement exit, how you should always be aware of what is called political risk. Now, going into a midterm election year, it is noted and historically that it always went out of it always ended the year or into the next quarter on more of a bullish type of outlook, or more of a look that is very favorable. That's 80% of the time. There is no guarantees in the market. If you don't know that, you know that now. There are no guarantees in the market. But in a mid-year, midterm, mid-election, that's normally the case. But we have some unusual circumstances right now. We have a war and some other things going on, so just be on the lookout for that. Other major news. This will be, I will be able to share anything significant in the mutual fund sector or I think you should know about concerning your retirement portfolio. They will be non-aggressive position moves, but moves more the less you might want to be aware of and you might want to bring up to your financial professional. One major move this week was Kelloggs, your favorite cereal company, is splitting itself into 3 separate companies. They will still keep the cereal company, which will be named North American Cereal Company. They will also have Company 2, and that company will be called Global Snacking Co. Inside of that company you have your Pringles and my favorite Cheez-Its and companies of that and brands of that sort. Lastly, they will have a third company by the name, it's called Plant Co. They will be purely an organic or natural play. And when companies normally do that, they want to unlock shareholder value. From what I understand, the cereal brands is dragging down the overall growth of the snack brand, which is growing tremendously. If you have Vanguard as one of your fund families in your retirement plan, they are one of the largest holders of Kellogg's. So I just wanted you to know that. They may or may not benefit you in this breakup, so pay attention to that. Now, let's look at a long-term play as we somewhat wrap this show up. A long-term play is FedEx announced last week in their earnings that they were going to be doing a dividend increase. What that basically means is for any shareholders, they're going to be paying them a little bit extra on their dividends or return of shareholder profits. They're going to increase that. A long-term play on that is the Dodge and Cox mutual fund family own the largest institutional stake in that company. They own about 5% of that. I would like to end with some good news this week. The markets ended up, and they had a pretty good week. We've had the last 3 weeks have been brutal. Mostly the last 2 weeks have been extremely brutal, and that's in anticipation of what the Feds were going to say. But this week ended up pretty good. All 34 U.S. banks passed what is called a stress test, where they look at their books and worst case scenarios that are happening in the bank's financials to see if they can handle anything substantial or anything uncertain. All 34 U.S. banks passed. With that being said, I think that signaled the stock market to have ended off on a pretty good week. Thank you for joining me here this week on a Retirement Planning Show. This show was sponsored in part by retirementplanning.tools. Retirementplanning.tools, a one-stop portal for all of your retirement needs. Until next week, this has been Jenny Jones. Thank you so much.